Gold has been on an absolutely spectacular run lately, smashing records left and right and, really capturing headlines. But this massive surge has everyone asking a pretty crucial question. Are we watching a new golden era for this classic safe haven asset? Or are we right on the edge of a speculative bubble that's about to pop? So let's peel back the layers of this rally and see what's really going on underneath.
And that really gets to the heart of the matter, doesn't it? Is gold's record price a sign of its enduring strength in a really volatile world? Or is it a kind of gilded trap, luring investors in just before a sharp, painful correction? The answer? Well, it has huge implications for just about everyone, from massive central banks all the way down to individual households.
And believe me, the stakes could not be higher. We've seen prices just soar towards levels we've never seen before, with some analysts even talking about peaks of $4,000 an ounce or even more. Look, this isn't just another rally. This is completely uncharted territory, and it's forcing a really serious conversation about value, about risk, and of course, about what comes next.
Okay, so what in the world is fueling this fire? Before we can really talk about the risk of a bubble, we first have to get a handle on the powerful forces that have pushed gold to these incredible new heights.
It feels like this rally is being pulled in two totally different directions. On the one hand, you've got those classic, age-old arguments for holding gold. It's a hedge against inflation, right? A shield when currencies look weak, and a reliable store of value when things get shaky geopolitically. Central banks all over the world are stocking up for these very reasons. But then, on the other hand, you have this different, much more volatile force at play, pure speculative momentum. This is that fear of missing out, or FOMO, where rising prices just attract more and more buyers, creating this feedback loop that can get totally disconnected from the fundamentals.
This isn't gold's first rodeo, not by a long shot. To really understand what's happening right now, we need to take a quick look back at the key moments that shaped its modern identity as a speculative asset.
Gold's journey as a modern investment really kicked off in 1971. The Nixon shock, that was the absolute game changer. It severed the dollar's link to gold and just let its price float freely. Then you have the 1980 peak, which shows us just how powerfully inflation fears can drive prices up and how hard they can crash for decades afterward. And of course, the 2011 peak reminds us that big financial crises send investors scrambling for safety. The key takeaway, each one of these historic rallies was followed by a pretty sharp correction, giving us a crucial playbook for what might happen this time.
So with all that history in mind, let's bring it back to the present. Are we seeing those same classic fingerprints of a speculative bubble forming right now? Well, there are a few key warning signs that are definitely flashing red.
First up, overvaluation. Now, the thing with gold is that it doesn't pay a dividend or have any earnings, so its intrinsic value is, it's notoriously hard to pin down. But when we adjust for inflation and look at its price in real terms, we see a pretty stark picture. At its recent highs, gold's real price was nearly 60% higher than that legendary 1980 peak. That right there is a major red flag.
The second sign is all about psychology. It's herding behavior. This is what happens when the story just becomes prices keep going up, and investors pile in simply because everyone else is. It's a phenomenon that some have brilliantly called gold-plated FOMO, and let me tell you, it's a classic ingredient in pretty much every speculative mania in history.
In this quote, wow, it just hits the nail on the head. It really crystallizes the core dilemma we're facing. Investors are flocking to gold to escape what they see as bubbles in other assets. But what if that very scramble for safety is creating the most dangerous bubble of all? It's a really powerful and, frankly, unsettling thought.
Okay, so let's say this bubble does burst. What does that actually look like on the ground? We've mapped out 3 different scenarios, from a mild correction to a severe crash, to really understand the potential fallout for investors, for economies, and for you.
First up, let's talk about the most probable outcome, a mild correction. We're talking a pullback of maybe 10 to 20%, likely driven by some simple profit-taking or just a minor shift in market mood. The really crucial point here is that the impact would be contained. Yeah, globally, some traders who are heavily leveraged would feel the pain, but it wouldn't cause widespread panic. In a huge gold market like India, the central bank might see a paper loss of around $15 billion, but there'd be no real systemic stress. That means no risk of a domino effect that could topple the wider financial system. It's a shock the market could pretty easily absorb. All right, now let's ratchet it up to scenario B, a moderate burst with a 30 to 50% drop in price. A likely trigger for something like this could be a sharp rise in real interest rates. Now, simply put, that's the return you get on a safe investment after you account for inflation. When those real rates go up, holding gold, which remember pays no interest, suddenly becomes a lot less attractive, and investors might just rush for the exits all at once.
In this scenario, the consequences become pretty material. Globally, big investment funds and central banks would be looking at significant mark-to-market losses, meaning their assets are suddenly worth a lot less on paper, which can trigger margin calls and force selling. In India, the Reserve Bank's paper loss jumps to around $40 billion, raising some really serious questions about its reserve management. And lenders who give out loans against gold, they'd face serious stress, and the hit to household wealth could be big enough to actually slow down consumer spending across the whole economy.
And to put a number on that household impact, a 40% drop in the price of gold could erase an estimated $1.5 trillion of notional wealth from Indian households. Now, a lot of this is unrealized since it's physical gold, but still, that is a massive blow to family balance sheets.
And finally, we have to consider the worst-case scenario, a severe burst, wiping out 50 to 80% or even more of gold's value. This would be a true full-blown confidence collapse, a historic event right up there with the bursting of other major asset bubbles.
In this scenario, the impact is, well, severe. Globally, a crash of this size could trigger contagion, where the losses in gold markets spill over into other assets and create serious credit stress. For India, the RBI's paper losses swell to a headline-shocking $60 billion. But the real danger here is systemic risk. The stress on banks that are exposed to gold loans could become so great that it actually threatens the stability of the entire financial system, a true domino effect. And the blow to household confidence and wealth would be absolutely immense, potentially triggering a sharp recession.
So, knowing all these potential outcomes, what should we be watching for? This last section is all about a practical checklist, the key indicators that could signal a change in the market's direction.
So what are the key signals to keep an eye on? 4 indicators really stand out. First, track U.S. real yields, which we just talked about, and the strength of the dollar. Both of those typically move in the opposite direction of gold. Second, monitor what the central banks are doing. If they suddenly shift from buying to selling, a huge pillar of support is just gone. Third, watch the money flows in financial products like gold ETFs. And finally, in a market like India, keeping an eye on default trends in the gold loan sector can give you a critical, on-the-ground signal of emerging stress.
Which of course brings us right back to our fundamental question. After millennia as the ultimate store of value, has gold's modern, financialized form turned it into the ultimate speculative asset? The answer is going to unfold in the markets, day by day. But understanding the drivers, the history, and the potential fallout, that's the absolute best first step in navigating whatever comes next.